ESG Investing at an Inflection Point. We have with us today Mr. Chirag Mehta, Senior Fund Manager, Alternative Investments, and Ms. Neha Joshi, Associate Fund Manager, Alternative Investments. With the new year upon us, we can all breathe a small sigh of relief that the roller coaster of a year 2020 has finally passed. But as we look forward to the investment opportunities of a brand new year, we must also take time to reflect and review on the lessons learned in 2020 in order to become better investors. So today, Chirag and Sneha will be talking to us about how 2020 taught us the importance of ESG investing, whether ESG investing makes business sense, and how it can keep your portfolio resilient during a market downturn. We have dedicated time post their presentation for taking live questions, so we encourage you to send across your questions for Chirag and Sneha on the chat. And now, without further ado, let's get started. Over to you, Chirag.
Thank you, Gasul, and thank you all investors for joining us today. We hope we will certainly let you know what ESG investing is today and how it can make a carve out in your portfolio so that an allocation to ESG, why it is a necessary allocation at the end of the day, is what we think you will take away. And how it would have helped your portfolio this year in a year where there were a lot of unknowns and uncertainty out there. Uh, ESG, as you all may know, that it stands for environmental, social, and governance. We'll come to the details of that going forward, but let's see what's happening in the world and where ESG connects in terms of investing and how it is taking off. So if you see this chart, it clearly says that how institutional investors today are getting into ESG in a very big way. It all started in 2006 with UN starting something called as Principles of Responsible Investing for various institutional investors like pension funds, sovereign wealth funds, those kind of institutional investors. And today, if you see, it was a small start, a slow start. But now today, if you see, as evidence keeps growing, we have more than 3,000 investors who say that incrementally, I will move towards ESG. And they are embracing ESG with open hands, right? So ESG investing is not only signatories saying that my investments will going forward be reflective of ESG principles or responsible investing principles. It also saying that there is big AUM getting into it. If you see, all these 3,000 signatories have total AUM of more than $100 trillion, 110 trillion to be precise. So it's really great, getting bigger by the day. And it's not just saying that it's a fad and therefore I need to get into it. Somewhere it's kind of driven by mandates, by governments, or in some places they are looking at the evidence that ESG certainly works, and we'll show you in evidence how it works, and therefore they're getting into it. So it is one of the fastest growing investment approach globally. We are seeing all kinds of investors getting into the ESG investing, and it's growing rapidly. And who these investors are? These are the biggest of fund houses globally. Like you have BlackRock, pensions funds from California, the CalPERS, CalSTRS. You have the Sovereign Wealth Fund of Norway, Allianz, T. Rowe Price, all big investors who have huge amounts of AUM. If you see on the left-hand side, it's billions and trillions of dollars of investments that they manage. And they're saying that incrementally a lot of money will move towards responsible investing or ESG driven investments. So these are 301 signatories, and they are adding to the list every year. And currently, if you see of that 110 trillion, about 25 trillion is already branded as ESG. It is ESG themed. It may be touching upon some aspects of ESG or a holistic ESG overall. So you have investors who are getting into ESG in a very big way, and it's not that these are very renowned investment houses, and they're getting into it after seeing evidence of ESG certainly delivering at the end of the day. So we think that ESG is still a great opportunity. You would have seen fund houses in the Indian mutual fund landscape also launching funds over last year in 2020, which are ESG funds. So it is getting big. It is getting into acceptance not only from institutions institutional investors, fund houses, also from other investors who say, yeah, it really makes sense to get into ESG because it says or it does more than traditional investing. Like it does deliver profits and it also takes care of the environment and society. We'll look at factors going forward, but what these big investors that are getting into ESG are saying, they're saying that sustainable transition is occurring around the world. There is a need to have sustainability at the core of what we do, and it begins, I think, at investing, because investing, according to me, has great power to transform corporate behavior. And therefore, if you say that I will invest only in responsible companies, that means that companies will have to get their act together, not only at earning the profit for you, but also looking at the society, the environment in which they operate, right? What does Norges Bank say, who has been adopting ESG since a long time? They're saying that it helps to promote the long-term economic performance of their investments. So it's not charity. It is saying that it does help their portfolio at the end of the day. And if you see Robeco, who's also a big proponent of ESG investing, they're saying that ESG has worked as a performance cushion during the sell-off. During the COVID sell-off, most across the globe, there was panic in stock markets. Everything had a fall of 30, 40%. And ESG kind of outperformed during this sell-off. So it really said that yes, ESG investing works. It helps kind of cushion during the downsides and also performs on the upside. That we'll see in terms of real evidence in terms of how it has done. So currently, if you see, ESG investing is close to about 25 to 30 trillion dollars, and it's forecasted that over next few years, it's going to keep increasing in terms of the mandate that ESG has, right? By 2036, it will be what is currently 25 trillion is going to become more than 150 trillion. That's a forecast. It's not a forecast just based on Excel model that kind of gives you a linear progression, but it is based on the surveys or of these signatories who are getting into ESG, how incrementally they're going to allocate to ESG, and that is what this chart reflects. It is their anticipation in terms of their AUM moving towards from traditional investing towards ESG investing. And if you see, it's kind of a hockey stick curve where it is from 25 trillion, it kind of moves towards the 150 trillion mark. And as I said, this is the survey. It is a Deloitte survey of managers in the US of professionally managed assets, how it's going to grow towards ESG investing. Like ESG investing in the US in 2018 was just 12 trillion. By 25, it is anticipated based on what managers themselves have communicated in a survey, it is going to go to $34 trillion. So what is traditional investing, which is around 34 trillion, remains around 34 trillion. And ESG investing, which is 12 trillion, becomes 34 trillion, equivalent to what traditional investing is today. So incrementally, whatever money goes into institutions that manage money will certainly be ESG, right? Also, this is again a survey from Callan Institute, which also says that in the US, 42% of institutional investors had incorporated ESG in 2019. And going forward, more investors will adopt. If you see the same number in 2013, it was just 22%. So as evidence grows, people are adopting or fund managers are adopting ESG into their investing, right? So it is kind of institutional investors are usually uh, they come in first in terms of adopting a certain way of investing, and it is then the retail investors kind of jump in after most of the institutions have come in. ESG is at that juncture today that it allows even retail investors like you and me to kind of get into ESG investing alongside institutional investors, right? We know by what we have seen previously that institutional investors will incrementally allocate more to ESG. In retail investors, again, have this opportunity to ride the curve when institutional investors kind of keep allocating to ESG further. So I think it is time that ESG investing is embraced by retail investors as well. And there are benefits. We'll come to that going forward. But there are certainly the benefits of not only earning profits, but also doing good. So what is ESG all about? We all know that it stands for environment, social governance, but what does it do? What does it take to be an ESG fund? What does an ESG fund manager do? What kind of research goes into towards ESG? So we've all seen things like responsible investing, clean investing, impact investing, all are buzzwords around uh, better investing. But all ESG kind of sort of is a holistic of all these things, right? Sustainability, responsible investing, clean investing, societal impact. If you see the pie chart on the right hand side, where you see three circles, we all talk about only one thing when it comes to investing: shareholder value. What is in it for me? What kind of profit this company will make and share it with me? So, what is that shareholder value, right? We also talk that invest companies should kind of deliver that shareholder value, good returns to investors over a long term, and that can only happen when the corporate lives longer, right? And when we expect these two things cannot happen in isolation if the company has a bad societal impact, right? Only if the long-term societal impact starts getting positive, that is when the corporate is going to live longer. Otherwise, it will die. It will not be able to survive the competition, or it will not be able to get the revenues increasing and therefore be in trouble. And therefore, a positive societal impact will lead to a corporate living longer, the corporate longevity that we talk about, and therefore better long-term shareholder value. So if societal impact is negative, it's going to be trouble for the company. So ESG investing just asks one question. Instead of how much return that we are used to asking for our investments, it changes into how much sustainable return, right? When we say sustainable, it's just not for us, it's also for the environment we live in and also for the society. So would you want to invest in companies that kind of pollutes significantly and be with it, right? I don't think we all can tolerate that. Do you want to invest in companies that kind of dump their waste in lakes and rivers? Certainly not, right? So ESG investing, the environmental aspect, looks at companies' practices when it comes to pollution, when it comes to waste management, when it comes to their water usage practices, those kind of things. When it comes to social factors, they look about for many, social factor stops at just corporate social responsibility. We all know that companies need to spend 2% of their profits on CSR, corporate social responsibility. But there is much more to the social angle of a company, right? CSR, we say that is the company spending 2% or not, which is required by law. But we have to look into how the company spends that. uh, I mean, education is a big component of social factor, right? To encourage education, giving donations to educational institutes. But when a corporate gives educational loans or supports education at an institution where people of the rich go, is that CSR? That's not CSR. That is your money, your profits being diverted to CSR, but you want that it being utilized in a proper manner, right? Social factors look into all those kind of things, looks at labor practices. If you have good employee relations, if employees are happy, those companies usually thrive. So what are the employee or labor practices of that company, how they treat their employees? That is what the social factors looks at. Like privacy and data security has become incrementally important. So what are the policies that the company has? Is it doing enough to protect data of their customers, of their investors? So it goes into various details on those aspects. And if company doesn't fail, or company fails on those aspects, it doesn't become part of an ESG fund, right? So somewhere it kind of mitigates the risk that are inherent if that continue to stay beyond beneath the company's operations, but somewhere down the line, those things get caught and the company will be in trouble. So if if you can identify the social factors which are material to the company and kind of pay attention to it, then the risk to a company or your investment is reduced to that extent. And when it comes to governance, we always have known that it is one of the important criteria to see when you invest in a company, right? How does that treat the minority shareholders, you, me, or the fund management industry, the insurance companies, the institutional investors, all are minority shareholders to some extent, right? How does the company treat these shareholders? Are they treating these shareholders or minority shareholders at par with the promoter, or they are not treating it? So for example, is the company benefiting just the promoter, or is it for everyone? When it comes to shareholders, we all are equal, right? And therefore, to be treated equally. If the promoter is contributing to running the business, they may get a salary, they may get a bonus, but when it comes to share prices or shareholder rights, we all are equal in that sense. Board independence. Many times this is a question. This is always certain times very questionable, right? Uh, Many times promoters pick up their family, friends on the board and call them as independent. Are they really independent? They're gonna not work in your favor as a minority shareholder. They're gonna always gonna work in the favor of the promoter, and therefore that board independence is very important when you invest in any company. uh, there are issues surrounding executive compensation, for like the CEO getting uh, significantly higher than the median employee in the company. Those companies usually kind of don't have a fair policy in terms of their wage distribution, and therefore they may not have very happy employees at the end of the day. So executive compensation practices are also very important. So if you see, all these are non-financial factors, but they tend to have a material impact on the valuation of a company, right? You cannot ignore these factors, and these are becoming very important. We'll go in further slides to show you how important these factors are becoming, and why you need to pay attention to these factors. And that is why the global world, the institutional investors are focusing on these factors when it comes to their investments. So let us see each of these in detail. Environment, social, and governance factors. Where does India stand, and therefore is that a risk to your investments or not? Right? There is high water stress in India. Like 54% of India is under high water stress. Right? 21 Indian cities will run out of groundwater this year. Right? Uh, or last year. It's already done. So we have more incrementally more and more issues surrounding the water security. When we say water security, it's clean water, the availability of clean water that is under stress. When it comes to energy, we are very much reliant on coal for our energy. We burn coal to get our energy. 92% of commercial energy consumption and 75% of the total consumption comes by burning coal. Is that leads to pollution incrementally as our energy needs increase or across the country. More coal burning will cause climate damage to a significant extent. So therefore, we need to pay attention to that. We'll come to where we stand and whether the world will tolerate India's growth, which leads to a lot of carbon emissions or a lot of pollution. We are already number 3 in carbon emissions. Our pollution, if you count globally, though on a per capita basis, individually, because it's a country with lot many people, our per capita basis, we are very low, but we are already number 3 globally, right? And we are just starting to grow, right? And as we grow, the byproduct of that growth is pollution. 11 out of the top 12 polluted cities are in India. So we do have a challenge on the environment front when it comes to water, when it comes to waste, and when it comes to pollution. On the social factor, we have our own challenges again. We still have 18% of the population below the poverty line. Food security, we are okay currently. We have good food stocks. But if you see the math, we are 2.4% of the world's land and 17% of world's population. It's a big mismatch there. Somewhere, if we don't pay attention, this will come to haunt us, right? On the employment side, we have this is, I mean, you would have often heard us telling you that employment is really big problem for India, right? We have overall problem when it comes to employing the youth that is coming out of education and wanting jobs, right? We need to create somewhere around huge amount of jobs every year so that we can get this youth into the workforce. Uh, on the illiteracy front, even now, we have about 50% of the population which is still illiterate. Uh, Basic hygiene, we are just crawling towards basic hygiene in rural areas. The Prime Minister's toilet program is just addressing one portion of basic hygiene in rural areas. Healthcare system, COVID has again unearthed the big scarcity that we have on the healthcare side. We have significant problem on the healthcare. We have not made enough investments in healthcare, and that is why the system that we have is not adequate. And when it comes to rural areas, it's even more. 50% of the villages don't even access to like basic healthcare facilities. So we do have a very big social problem as well in India. We need to address it. We can't say that I will just focus on economic growth, wealth, profits. You need to understand the society and your wealth are all sailing in the same boat, right? Governance, the lesser said, it's been a very important pillar when it comes to investing. At Quantum, we have been looking at governance as an important criteria for investment since 1996. And we still continue to think that governance is a very important area to focus on when it comes to investing. So it's kind of a non-negotiable. We have seen many times that there were problems of or bad governance or inadequate governance in a company, and how shareholders have lost value. So we have seen that credit rating agencies were behind the curve in highlighting problems. Therefore, we have seen investors losing money because of defaults in ILFS, Z Group, DHFL. I already touched upon independent directors which are termed independent, but are really dependent or friends and family of the promoters. In India, we have 15 out of the 20 business groups which are family owned. And when you have family owned businesses, the promoter kind of does what they want to do, right? So you usually see a lot of governance issues when it comes to promoter run entities, which are like family owned groups. We already had an audit crisis in 2018. Auditors of 204 listed companies resigned in that year. And if you had seen the same number in a previous year, the 16, 17, it was just 18. Suddenly, auditors were held more accountable in terms of their audits. They couldn't be just the stamp on the paper. They were kind of made liable to the fairness of documents that they approve. And therefore, you saw that wherever there were kind of inadequate information to the auditors, they kind of said that it's better I don't part with I part with the company. I don't be involved as an auditor with the company. And therefore, you saw a lot of auditors resigning in just that single year. So when we talk about all the areas which are very, very important, ESG, on the climate side especially, we have our own issues, right? India has not created the climate problem, but India has to be part of any solution that the world comes to when it comes to solving the climate problem, right? India per se emissions are still very, very low on a per capita basis. Uh, but as we grow, the byproduct of that growth is going to be pollution that we said. But what kind of additional pollution that it can bring? The way India grows, maybe it grows like the world average, maybe it grows like China, maybe it grows like USA. So depending on how it grows, it will add about 8 to 35% of pollution to the global world. Do you think the global countries like US, Europe are talking about cutting pollution, cutting their emissions? Would they allow someone to undo what they are doing, right? If they are cutting and India keeps adding, the world remains where it is or incrementally goes towards higher emissions, right? So I don't think the world is here to tolerate. And when world is looking at India in terms of how it is growing with high pollution or it is not growing with high pollution. So depending on they will continue to monitor and pressurize India to lower its carbon emissions, lower its pollution as it grows. And therefore, when the world pressures India, the government, the companies, and consumers will be under stress to kind of adhere to certain climate restrictions, right? And therefore, if your companies that you have invested with is having high emissions, then you may have some issues going forward because regulations will get tighter day by day, and the companies will have to foresee this challenge and be ready to mitigate that. Uh, 2020, it's a year where a lot of uncertainty, lot of losses have happened because of the lockdowns that we had seen across the globe. And if you see, in some way, we are still counting the cost that the world had to bear for 2020, right? If you see, it costed world nearly $12 trillion, about 8% of world GDP. And if you see the economic growth, there was a big loss of economic growth, not only in India, but across the globe. There was a big increase in unemployment across the globe. We are still moving towards getting all those unemployed towards employment. So it will still take a few years. The 2008 crisis, the global financial crisis, took about 5 years to get back to get these unemployed employed. Therefore, this was much severe than that. For example, in the US, last time in the global financial crisis, we saw around 8 to 9 million people uh, getting unemployed. This time at peak, it was close to more than 20 million people getting unemployed. So this crisis will take its time to get all those unemployed back into employment. It has also added to global poverty. We already have issues like extreme poverty. I think it has added to the disparity even further. The world was divided in terms of its response. So inequality has increased further across the globe. Like if you see nations like US have done more in terms of handouts directly to people, and therefore that has helped people. Countries like India have not done enough in terms of giving handouts to people, and therefore inequality in India has increased further. Uh, if you see, climate have is over last few years have had adverse effect and cost billions of dollars, right? If you see any crisis, it has cost somewhere between a $5 billion to $40 billion of kind of damage. And if we don't pay attention, like scientists have said, we need to ensure that our temperatures don't increase beyond the 2 degrees Celsius mark. If it happens, then there will be irreversible damage to climate, and therefore there will be a lot of impact on the activities that happen, especially agriculture, right? Agriculture, availability of water, all those things we'll have frequent floods, droughts, those kind of climatic changes will happen. So it's better that we kind of pay attention to that. Even in India, if you see last 3 years, 18, 19, 20, to give you an example, there have been many events on the climatic side that have caused destruction, and we had to pay damage of those for those events. For example, Kerala floods costed us $3.7 billion. The Feni cyclone costed $8.1 billion. The cyclone Amphin and the floods that came after that cost us $23 billion. So incrementally, we as consumers or companies, because of the operations being shut or factories being damaged because of events, are having to pay a big price for that. So if you see, economic growth is not only enough. When we say I just want, no matter what happens, I'm just worried about my profit when it comes to my investment, that's not going to help us, right? Economic growth is not only enough to sustain societies and planet. We need to do more. India is the fifth most vulnerable to climate change risk. We have a big agrarian economy. A lot of people depend on agriculture, and if climatic conditions tend to alter agriculture and have an adverse impact on agriculture, then we will face a tough time, right? On gender equality, we already have issues. We rank 108th out of 153 on gender equality. So we have very poor female participation in the labor force, especially in many technology and other companies are okay. But if you see, other sectors are just lagging behind on gender equality. India ranks 77th in global bribery risk matrix out of 194 countries. So even that is an issue. Like ethics, fraud are another area where ESG focuses. India is among the top worst countries for working people. So we don't have good working environment or culture in many industries or companies, and those companies will at some point in time face a tough time when it comes to their growth. So all this calls for a collaborative action. We have problems for sure. We have our own challenges, but we can overcome those challenges by collaborative action. We all can combine forces to try and overcome those, right? Most investment strategies, if you see, are not some. There are some who don't even kind of dig deeper into the governance aspects. But if you see, many of those kind of focus primarily in governance, how founders and managements treat minority shareholders, right? But it's time to go beyond and ask, what about employees, society, land, water, air around the factories? What about the environment and the society we live in? And think of the triple bottom line: planet, people, and profit. Of course, profit, uh, people think that I will have to sacrifice profit if I have to take care about planet and people. That's a mistaken belief. That's a myth. Uh, Responsibility and profitability are complementary to each other and not opposing views, right? So your long-term profits, as we saw in that five circle charts, uh, long-term profits will only happen if you have a positive societal impact, if you have a better environment and a better society. And if you don't pay attention to these, we have seen many occasions where investors had to pay a big price. For example, J&K Bank, where in CSR funds were diverted for different purposes, not meant for CSR, and the loans were being offered to people recommended politicians, so not good governance practices. And when this was unearthed and when this came to light, the stock fell by 20% in one day, right? Sunfarm, everyone knows that there was a whistleblower claim of financial irregularities in the company. And when this news broke out, post that, the stock fell by 26% in 2 months. 1% Beverage is another company where the auditor resigned, saying the company doesn't give me enough information. Uh, that was a news that cautioned investors on the governance practices. Stock fell by about 40% in 2 days after this news. Wakarangi was under SEBI scanner for alleged manipulation of price and volumes on its own stock. Uh, Again, bad governance aspect. Stock fell by 48% in 5 days after this news. Vedanta's bauxite mining plans were rejected by the government because of issues surrounding pollution in that area. Again, a social and environmental problem. The stock after this rejection fell by about 66% in 2 years. And we all know Satyam Computers, which was part of the index, a very popular stock at that time. You would have seen in many portfolios. where the chairman confessed of a fraud and falsifying accounts of the company. Uh, when that news came, the stock fell by 78% in one day. You, as investors, had to bear real losses in these instances if you were an investor. And if you were looking at ESG practices of companies, you might not have these companies in your portfolio or in your holding. So ESG helps you to unearth the problems within the company when it comes to ESG, and therefore it helps you to mitigate those risks. But don't think that ESG is just about mitigating risk. It is more about identifying opportunities, right? Uh, it tells you whether the company is ready for the next disruptive change or not. We look at it's very forward looking. It's not only backward looking. It looks at whether what kind of changes are happening globally in India, within that sector, within that company's line of business, and whether the company is ready for the disruptive change or not, right? Whether the company is ready for tomorrow's challenges or not. And if not, then it will not be part of an ESG fund, right? It looks at the financial sustainability of the company, whether the company has efficiently deployed its capital, whether it is financially stable or not, does it respect the environment in the society, what kind of management it has, what kind of board it has, what kind of ethics it has, and what are overall the governance practices. So it looks at whether the company, if you have these traits in a company, then only it will be able to uh, lap on the opportunities that are present or that are coming. And if not, then the company will not be able to go to that growth path that you're envisioning. So it's not about mitigating risk. It is about whether the company is in a position to lap on the opportunities of tomorrow or not. So now comes to the main part where most investors are interested, right? Is there a, okay, this all sounds good. I want to be part of it. But at the end of the day, do I have to compromise on the profits, or do I get better profits, or do I get similar profits as compared to traditional funds, right? So there is some evidence out there which you can see. Uh, there is an Oxford study which looked at various ESG studies overall, and found that when you have a good ESG company, a strong ESG profile, 90% of those companies have lower costs of capital, 88% have higher operational performance, and 80% have higher share price performance. So more or less it has worked in investors' favor. And if you see the logic, it's kind of very relevant, right? So if you have a strong ESG profile, means you are better at managing risk. You have lower tail risk. You have lesser risk of incidents, and therefore company people will treat this business or this company as a low risk. And when it is low risk, you investors ready to lend to that business at a lower interest rates, right? And when it comes to lower, it has a lower cost of capital, it will certainly have a higher profitability and therefore a higher valuation. So it kind of logically sounds all right that yes, ESG will work. Let us see more evidence. Uh, if you see, this is the MSCI ESG index. What is the MSCI India index? The orange line is the normal stock market cap weighted index, like you have the BSE 30 or Nifty 50. It's a similar index. And the blue line is the ESG index. Good ESG companies from the same MSCI India index picked up. And if you see, ESG has done better than the normal stock market index, and by a margin. And it is not one period that has contributed to the outperformance, it has steadily increased over a period of time, right? So ESG has certainly worked, or ESG index has worked than the normal stock market index. And if you see the table on the right hand side, years when market fell, right, ESG fell lesser. For example, in 2008, ESG fell by about 51%, whereas the normal stock market index fell by 56%. In 2011, normal stock market index fell by 25%, and ESG fell by just 18%. So it has helped not only outperform, but protected risk on the downside, right? This is again ESG index from Nifty vis-a-vis the normal Nifty 100 index, right? If you see the blue line, this is ESG has outperformed the normal stock market index, right? So ESG certainly has proved its mettle amidst crisis, right? But does it lead to a higher performance? Is there a evidence that a ESG company does better than companies which are not as good as in those E, S, and G traits, right? Uh, if you see, there is a company called Sri Cement belonging to the cement sector, and in cement, as you would know, is a highly polluting sector. About 5-6% of the global pollution comes from cement as a sector, right? But is there an alternative to cement? Not really, right? We all need roads, we all need infrastructure, which will need cement. But are there companies within that sector that are doing beyond than what traditional companies are? Are they doing something that reduces their pollution, that reduces their water usage? Are there examples? Sri Cement is a very good example of that, right? 39% of its energy is produced from all renewable sources, alternative sources. They use waste heat recovery systems and solar energy for 39% of its operations. They use 23.5% of alternative raw materials. Like limestone is a key raw material for manufacturing cement, and as we all know, limestone is scarce resource, right? There is scarcity of limestone, and therefore it has been trying to move away from limestone usage and using alternative raw materials. That also helps in reducing the pollution created by that cement operation, right? All plants comply with zero liquid discharge norms. They don't discharge liquid which goes and mixes in groundwater, lakes, and rivers, right? They don't discharge any liquid. They use air cooled condensers. Most typical cement plants use water cooled condensers to cool their plants. And all contracts that they have also include clauses with suppliers that are based on environment and social aspects. So a good, very good example, which is a highly polluting sector, but doing much more to kind of move on better environmental practices, right? And if you see the Sri Cement's performance vis-a-vis big companies like ACC, Ultratech, Ambuja, over long time periods, it has done significantly better than any other cement company out there, right? So it has good environmental practices and has done better in terms of share price performance. This is again a comparison of various indices. Two on the left are ESG indices, and three on the right are normal stock market indexes: Nifty 50, BSC 200, and MSCI India Index. And if you see, ESG indexes have done significantly better in terms of returns. And it has, if you see, lower downsides, lower volatility as compared to normal stock market indexes, right? So it has done, ESG certainly has delivered better performance than the normal stock market index. And this is the evidence that institutional investors are looking at and saying incrementally more of my money will move to ESG. This is what is leading to that inflection point. It's not driven by investors pouring money into it just for the sake of it or whether it is a good thing, but there is evidence that it delivers on profitability in terms of returns, and therefore it is certainly at an inflection point right now. This is again how the top two lines in the graph are ESG indices, and they have done far better than the normal stock market index. So with that, I hope I have given you enough food for thought when it comes to embracing ESG for your investments. Going forward, I'll invite my colleague Sneha to tell you how we look at this ESG space, how we manage your fund, and how we try to deliver the triple bottom line in terms of the planet, people, and profit. Over to you, Sneha. Thank you.
Thank you so much, Chirag. This actually has set a very good tone for the coming part of the presentation. So I would just like to go to the next slide where I would like to talk about how exactly Quantum is looking at ESG and what exactly are we offering. So our analysis is based on the materiality of the issue. So what exactly are the material issues? So these are the ESG factors which would have a significant impact in positive as well as in negative sense on the company's business model and value drivers such as revenue growth, margins, the requirement of capital, and the risk. So it is important that we have a foundation based on material ESG factors. As we all know that if you look back at any big scandal around the world, or as Chirag had given some examples of companies which have have had governance issues, and you see how the share price has moved, it is important that there needs to be a good governance, because good governance promotes investors' confidence. If that is missing, then the risk of investing is significantly high. So our analysis is based on governance. So governance becomes the heart of our ESG process, and it is important that there is a diverse board and a strong and independent directors which are part of the board, who will not only take cognizance of E and S factors, but also they will act on it and become a voice for the shareholders to raise issues such as unfair executive compensation or issues related to gender inequality. So it is important that governance is the main factor which we look at when we are looking at ESG. And ultimately, what Quantum offers is identifying the companies which can act as a strong steward of your capital. And how exactly do we go about this process is something which we can see in the next slide, please. Next slide, please. Yeah. Uh, so we have developed a proprietary model for ESG scoring. So back in 2015, when we started researching on ESG, we set up an independent team to work on ESG and build a proprietary model which is based on disclosures and the quality of ESG factors that companies are taking into consideration and working on it. So for this purpose, we started looking at different data sources. So there is an international independent standard organization which is called as GRI. It has laid out a framework for businesses to use so that they can disclose their actions on ESG. So we look at a sustainability report which is based under the GRI framework. Back in 2015, SEBI, which is the regulator, has made it mandatory for top 100 companies to have a business responsibility report. So this report basically discloses what the company is doing on environment, social, and how it is engaging with its stakeholders. So now, in November 2019, SEBI has made it mandatory for 1,000 companies, top 1,000 companies based on market cap, to have an annual business responsibility report. So we also look at business responsibility report to evaluate our companies on ESG. Apart from that, we look at annual reports, we look at industry reports. We also look at one of the key factor, which is sustainability standard board's publication. So what this sustainability standard board publication does is it gives financial material drivers on ESG for different sectors and different industries. So there are many disclosures and many lot of information about ESG for different sectors and for different companies. But what SASB does is it identifies and gives major ESG material factors that can have a huge impact on the company's business operations and on its financial performance. What is most important to the investor? An investor is evaluating a company based on ESG. So we look at all these factors and we evaluate the company based on two things. One is the disclosure That is the amount of disclosures the company is providing on ESG, and the quality of disclosures. That means whether the company is actually walking the talk. And by combining these two things, we arrive at a consolidated score which ranges between plus 30, that means excellent on ESG, and minus 70, that means extremely poor on ESG.
Sneha, can I request you to please speak a little loudly?
Yeah, sure.
Your voice is not very clear. Thank you.
Thanks. So based on this, we arrive at the ESG score, which helps us in our portfolio selection. We can go to the next slide, please. So what quantum does is not just desk research or not just looking at different disclosures and coming to a score and investing based on that, but we have a process which is in three folds. One is that we do a lot of primary research based on sustainability reports, based on BRR, which is a business responsibility report. We look at industry reports, we look at reports of the company. And most importantly, we engage with the sustainability officers, we engage with the management of the company, we attend seminars and conferences to evaluate the company, and we try to get as much answers as we want on key questions related to ESG for a particular company. Then we have secondary research where we look at a company's board. We look at how independent the board is, how is the gender diversity, how is the quality of board, and what is the level of independence of the board. We also try to see whether there are issues related to related party transactions. We look at how the key personals are employed, how are they operating. We have a overall review for the management as well as the key personals, and then we also review the company on a twice a year, and there are backup for every company. So there are two people who work on each company, so that it is there is a continuity in the research process. And so it's not just desk research, it goes beyond that, and we ensure that we get all answers related to ESG for any company. We can go to the next slide, please. So coming to the stock selection process, first is the initial screen, which is based on the liquidity criteria. So we try to filter out companies which are highly liquid. So the companies which are trading on a daily basis over the last 1 year, uh, above $1 million or 7 crores, that becomes our initial universe, which is around 450 stocks. Then we go to the second filter, which is the ESG coverage. So the companies among the 450 stocks where we have ESG coverage, that is close to 140 companies now, becomes our ESG universe. And then the companies which are scoring positively, that is above zero, becomes the potential companies which can become the part of the portfolio. So eventually the portfolio will be in between 40 to 60 stocks. And we'll have the companies which are top performing in terms of ESG in different sectors, ensuring that there is enough diversification across sectors as well as across market caps. We can go to the next slide, please. So how do we exactly do the portfolio construction using our proprietary ESG model and scores? So first we check for liquidity, whether the stock is liquid enough, that is the volumes are above $1 million on a daily basis. Then second, we see whether there is ESG coverage on that. If there is no ESG coverage, then it goes to the research team who will start initiation on that company. If there is ESG coverage, then we see whether the ESG score is meeting our internal threshold. That is whether the ESG score is above 0.5% weight. If it happens, then that will become the part of the portfolio, and the ESG score will be reflected in the ESG weight. So higher the ESG score, the company will have higher weight in the portfolio. We'll have a minimum weight of 1% and the maximum weight of 5% for any particular stock in the portfolio, and will allow the stock to have up to 10% of weight on market value in the portfolio. To the next slide, please. So what exactly will you own if you have a ESG investment? You will have quality stocks. You will have stocks which have low volatility, which tend to do well in the down markets. We'll ensure that ESG portfolio avoids tail risks. So tail risks mainly occur because of tail events. Although tail events, the probability of happening is small, but the quantum of the effect is quite large. It can either have a very, very good effect or a very, very bad effect. So ESG focuses on avoiding that. And eventually we try to deliver long-term risk-adjusted sustainable performance over the long period. So ESG basically focuses on being a value agnostic fund and be true to its label and deliver something which is a pure ESG product. So does ESG truly works in the real world, or is it just something which looks good on paper? So we can look at the performance of the Quantum India ESG Equity Fund. This is a chart which talks about how the performance has been since inception. If you see the dip at the start of 2020, the Quantum India ESG Equity Fund fell by around minus 24.5%. But the benchmark, which is the Nifty 100 ESG index, fell more by minus 26.5%. And if you look at the recovery from the dip till the end of 2020, you see that Quantum India ESG Equity Fund has delivered a return of 25.7% vis-a-vis the benchmark return of 22.8%. So an outperformance in absolute terms of about 2.9%. And if we look at, if we compare it to other indices, that is Nifty and Sensex, the outperformance is even large. As against Nifty, the fund has given an outperformance of 9.7%, and as against Sensex, the outperformance is at 8.7%. So we can see that ESG definitely works, and it has fallen less as compared to traditional indices. And since inception, if we compare the returns, it has given an outperformance in absolute terms at 2.5% as against Nifty 100 ESG. And if we look at the outperformance against Nifty and Sensex, that is even more, and it's around 10% for Nifty and 7.7% for Sensex in absolute terms. So definitely we can say that ESG works in the real world. And going to the risk matrices, so does ESG actually delivers low volatility and low risk? So yes, it does. If you look at the standard deviation, the Quantum India ESG Equity Fund has the lowest standard deviation if we compare it with benchmark and Nifty and Sensex. Also, VAR, which is the measure of risk of loss of investment, it is the lowest for ESG fund. And the Sharpe ratio, which talks about the risk adjusted returns, it is highest for the ESG fund. And drawdown, which is an important measure to see how much the maximum loss there will be, it is the lowest for ESG as compared to other indices as well as the benchmark. So there have been a lot of questions about how this fund is, whether it is a thematic fund, whether it is a sectoral fund. So although it is categorized as a thematic fund, for all practical purposes, it is a diversified fund, and it is diversified not only across sectors but also across different market caps. If you look at the top 10 holdings, you can see that there is diversification in terms of sector as well as in terms of market cap. So just to give numbers, we have around 61% allocation to large caps, 29% allocation to mid cap, and 1% allocation to small cap. So there is enough diversification across the entire segment. So we can definitely say that ESG is a well diversified portfolio and not just a theme or a sector fund. Coming to the portfolio characteristics, if we compare ESG fund vis-a-vis BSE 30, we see that there is a high dividend yield for QESG fund as compared to the BSE 30 try. And we also see that the forward earnings potential is higher for ESG fund. And if you look at the diversification in terms of P multiple, the fund is well diversified across P multiples. So we are ensuring that we are not just buying expensive stocks, but we are making sure that it is well diversified across the PEs. Next slide, please. So what we recommend to the investors is that if you have 100 rupees to invest in equities, you can invest 60 rupees in quantum equity fund of funds, 20 rupees in ESG, and 20 rupees in long-term equity value fund. This not only ensures diversification across styles, but also diversification across funds. So when you choose ESG, that does not mean you have to choose between money and making a difference. You can have both. So investing money and making a difference, you definitely don't have to choose between the two when you look at ESG investing. Thank you, everybody.
Thank you, Sneha. Thank you, Chirag, for taking us to the presentation and for sharing the merits of ESG investing with our investors. Let's get started with the Q&A now. I'll start with you, Chirag. So equity investment is expected to be in a good company. So why is there a need for ESG investing? How would you respond to a critic who says that ESG investing is nothing but old wine in new bottle? Chirag, you're on mute. 1 second.
Yeah, so if you see, the factors surrounding environment in society are becoming increasingly important when it comes to your investments. It's not only from a risk perspective, but also from an opportunity perspective. So until now, governance has been an important area where many investors or many fund managers used to focus. But now you cannot ignore the non-material or non-financial factors like environment and society, right? So how do you get those factors into your investment? ESG allows you to look at it in a more structured manner, not only from a governance perspective, but also look at environmental and societal factors into your investments. So it's not old wine in new bottle in a way. It is because the materiality or impact of these factors has been increasing, and therefore the need to imbibe these factors into your investing. And ESG is still evolving overall. So no one has kind of perfected the science or art of ESG investing. It will continue to develop. It will continue to evolve, and as we find factors within these areas which are relevant and become increasingly important, they'll all become part of the ESG way of investing. So it's just giving prominence to factors which are becoming more important.
Sure. So, Chirag, how do you ensure that your portfolio companies are not greenwashing, but are actually walking, the sustainability path and creating real impact?
So we are well aware of the incentives that the company has in terms of greenwashing. They are seeing that there is loads of money from institutional investors coming into ESG companies, and therefore naturally they might, if they are not good at, they might want to pretend they are good at, and therefore greenwash their way out and get those capital attracted to them, right? So we are well aware, and therefore, as Neha explained, that ESG research at Quantum is just not desk research. We go out, visit plants, meet managements, meet all stakeholders, stakeholders around it. We meet various NGOs, the community where the plants are situated, to get more information of what the company is saying and what is doing is the same or not, right? So there is a verification mechanism that we try to build around the company's claims, and therefore trying to ensure that company is not greenwashing. For example, there are certain things like, for example, if company is saying that it is having carbon emission or pollution at X level, and we kind of try to verify it along with the company's electricity consumption, water consumption, those kind of things, you know. So it gives us, and we relatively rank companies or see it on a relative basis. A manufacturing unit, for example, of a two-wheeler for a company, and similar two-wheeler plant of another company, what are their energy consumption patterns, what are the emission patterns that they are disclosing. So it gives us a good comparative array of how we can compare or rank companies against each other, and therefore instances of greenwashing can get highlighted because of that comparison. So one is we kind of compare companies, we kind of look at various other ways to verify the claims that they are making, and we go and try to talk to various stakeholders to get the right information that we need. So that is how we will catch companies if they are involved in greenwashing.
Thanks, Chirag. Sneha, can you throw some light on how many mid and small cap companies would actually make it to the ESG pool, and what is the allocation to to large, mid, and small companies in the Quantum ESG fund?
Yeah, hi Rajat. So in terms of allocation, so we have around 29% allocation to mid-cap companies in the portfolio, and 1% allocation to the small cap companies. In terms of coverage, there is a decent coverage on mid and small cap, but it's still evolving. So for now, top 100 companies are mandated to disclose on ESG, but the rest of the companies in the mid and small segment are catching up. And with the new regulations coming in, that the top 1,000 companies uh, are are mandated to disclose annually a business responsibility report, there will be more companies which will be under coverage.
Sure, thanks. Uh, as a concept, ESG is abstract and not easily measurable. Your comments on that?
Yeah,
Either of you? Yeah.
I will just go ahead and then Chirag can pitch in. So yeah, it's a concept, but it does have a material impact on the financial performance and the shareholders' value. So what we do is we try to make the qualitative questions or qualitative factors which are evaluated under ESG into a scoring model, which gives which it gives the count, or rather, it makes us able to quantify the impact which the company is trying to create on ESG. So yeah, definitely you can say it is a concept, but what Quantum is doing in terms of its proprietary research and model is trying to convert the quality impact into a quantitative factor, which will help us in evaluating the company, just similar to how we evaluate the financial factor. Chirag, would you like to add?
Yeah, I'd like to add something here. Of course, there is a measurable impact in certain very tangible areas of companies' operations. Of course, the impact will be seen over a period of time, but of course, it could be measured in terms of carbon emissions of a company are known, how they are reducing. Currently, what we are testing is whether the company has the intent to kind of deliver on reducing or getting better at various aspects or not, right? And over a period of time, we will kind of have that measure as well. So on a portfolio basis, we are measuring the carbon intensity of the portfolio as well, right? And we want to ensure that this carbon intensity of the portfolio kind of reduces as we go forward. When will that happen? When the companies are in the portfolio kind of reduce their carbon emissions, and therefore it will help to showcase a better portfolio performance as far as the carbon emissions are concerned. Similarly, there are various metrics on the social side as well, like gender equality, pay parities, those kind of measures which help us demonstrate the impact of social factors within the ESG framework. So of course, there are certain tangible impacts that we can measure, and we will continue to see how we are improving on those factors or not.
Thanks. Going forward, is there scope for the quantum ESG fund to add international equity to the portfolio?
We are focused on Indian companies. We don't, at this point in time, intend to add a foreign portfolio companies in the portfolio. So as of now, no. We think that India has its own challenges. India has its own growth, and sustainable growth for India is the way forward. So we will continue to have India as our main focus for ESG investing.
Considering this is a new fund, the AUM of the fund is smaller right now. What are the possible risks that an investor would have to face because of the smaller AUM?
So typically, whenever investor invests in a fund, they need to ensure two things: whether they can enter easily and they can exit easily, and whether they are convinced of the process of investing or not. Right? We showcased you the process of investing. I hope you're convinced with that, and the performance that it delivered on as a byproduct of the process that we have. When it comes to investing, that's not a problem, or exiting is not a problem, because there is a liquidity criteria that we adhere to. Any stock that doesn't trade $1 million a day on an average for last 12 months will not make it to the portfolio, right? And therefore the portfolio stocks are very, very liquid. So if you were to ask me, current AUM of the fund is around 30-35 crores, in that range. The size of this fund can easily scale without us changing any of the characteristics of how we manage it today, is around 21,000 crores. So there is a high capacity of the fund, and therefore investors need not worry about liquidity, entry, exit of the fund. You can see the names that we own in the fund. The fact sheet is available, and you can really verify the scale that this fund can grow to. So as I've said, in our internal thing, based on the liquidity that we have, the current capacity without changing any characteristics is 21,000 crores.
Sure. Sneha, what is your reviewing methodology for selected companies, and what is the period of this review? And if you could give any recent example of a portfolio change or portfolio churn.
Sure. So in terms of review, we review every company twice a year. We are always on the lookout, and we monitor on a regular basis whether there are any kind of red flags, any kind of controversies which can be a potential risk for the company going forward. And there is a comprehensive review which happens twice a year. In between, there are updates in terms of meetings with the management, or any kind of conferences or seminars where we attend and meet the companies, and also interactions with the sustainability officers. And coming to your second part, as to how we are evaluating it. So there is a continuous process in which we have reports on each company, which gives us what is the material factors in terms of ESG for that company, and what exactly the company is doing in terms of improving on that, and also what actions the company has been taking or planning to do in the next coming years.
Thanks. Chirag, with markets running up so high, would it make sense now to add to this fund, or should one, wait for PE levels to normalize and then maybe take exposure?
Yeah, I know that markets are kind of trading at all-time highs and have moved up significantly overall. But in light of what we are seeing globally, the cost of money has reduced significantly, and that is one impetus to stock markets. So if we keep getting flows from foreign investors who are in search of yields, India could be a great destination for them. And we could see markets move. If that flows becomes real, then we could see markets going further higher as well. So from that perspective, given that there could be corrections on its way, there could be flows that will support markets. I think the best way to kind of get invested is at this juncture is to continue with your systematic investment plans. So I will advise that do your SIPs, continue to run SIPs in this fund. And if there is a correction, that is the time you could see make some lump sum investments. But don't forget that cost of money globally has reduced significantly. Central banks have printed a lot of money. There is a lot of liquidity. They have pumped around 10 11 trillion dollars globally of new printed money in the economies, and therefore that money will chase asset markets, given that there is very low yields in fixed income globally, and therefore given that they know India will keep growing at a pace maybe 5 6 7%, and which is much better growth than the developed world, that money could well come to India, and that could be if things go right, that could be big amount of money that can come into India. So if that comes, that will continue to propel markets higher. And therefore, it is difficult to take a call on liquidity. So at this point in time, continue with your systematic investment plans. And if there are corrections, you could tend or you could look at adding in lump sum.
Thanks, Chirag. Unless legally mandated, companies are not going to follow ESG in letter and spirit. What is your take on this?
I think times are changing. So are regulators, so are consumers, so are investors. So if the company, as I've said in my talk, that investment has great power to transform corporate behavior, and lot of these institutional money that will come to India, of what I've talked about, just pensions, sovereign wealth funds, they are all getting serious about ESG, and therefore they will look at ESG compliant companies when they make their investments. When they deploy the billions and trillions of dollars into India, they will look at ESG, because if you put ESG on a map of competing emerging markets, India ranks high ESG risk as on a relative basis as compared to other pure emerging market economies. And therefore, they not only to look at that the return that they get, but also to mitigate the risk that they have, they will look at ESG very, very seriously when it comes to India. So I think regulators are also getting very serious about ESG. So I don't think that they will kind of stay behind, because India can get serious amounts of money if regulators also propel these companies to become serious on ESG. So there is a push from investors, regulators, and consumers. Today's consumers is demanding safer, healthier choices as opposed to consumers of the past that could tolerate or were willing to tolerate, given that the seriousness of the problem was not that alarming. But today's consumers, the millennials, are demanding better products or accountability from these companies. And therefore, there will be serious risk from the company getting capital, company getting revenue growth for their products, and therefore company will have to follow sooner or later not only the letter of the law, but also in spirit.
Thanks, Chirag. Sneha, next question for you. One of your slides mentioned the Sharpe ratio. So one of the investors wants to better understand the Sharpe ratio. Is the higher Sharpe ratio better? He asks.
Yeah, so a Sharpe ratio is basically the risk adjusted return that you can get with a low volatility. So higher the Sharpe ratio, higher is your risk adjusted return, and that is complemented with a low volatility. So for ESG fund, the Sharpe ratio is much higher if we look at the numbers as compared to your benchmark, as well as compared to the traditional indices. So that supports the argument that ESG ESG delivers a long-term risk-adjusted return, and it also delivers low volatility.
Just to add, whenever investors make investments, they just look at one aspect, that is the returns aspect of their investment. They typically ignore the risk element of their investing. What Sharp ratio helps you measure? Okay, the fund manager has delivered returns, but has he taken higher risk to get that return? And therefore, if he has taken higher risk to get that return, he will have a lower Sharp ratio. He will have a lower risk adjusted return. A higher risk adjusted return says that the fund managers delivered better returns and taken lesser risk on a relative basis to get that return. So a higher Sharp ratio is always better for you, given that not only the fund has delivered return, but also kept risk into consideration.
Out of 4,500 plus listed companies, how many are expected to actually filter and meet the ESG criteria? And do you think this pool, is small to choose from?
Uh, it's not so small that we cannot build a portfolio. You can see the portfolio, it has 45 companies in there, which is a good diversified portfolio. Uh, yes, there are challenges in terms of out of so many companies, currently a handful of those companies are serious on ESG and giving us enough data so that we can analyze and assess them, right? So far we have covered about 135 companies on ESG, uh, and it is growing significantly every month. Uh, 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 but if you see, there are regulatory changes that are unfolding really fast. SEBI is making BRR, which is Business Responsibility Report, mandatory, which touches upon aspects of environment, social, and governance, the ESG, the data that we want. Uh, as regulations make it mandatory, they have mandated top 1,000 companies to disclose this information in BRR, the Business Responsibility Report. So we will, going forward, have a lot many companies disclosing a lot of information that we need. So today, there are enough companies that are leaders and they are giving good information, and we could cover 135 companies so far. Going forward, as we have more data availability given the push by regulators, the universe is likely to expand further.
Sure.
Just
Uh,
to add to what Chirag said, Ghazal,
yeah.
the companies itself is taking cognizance of the fact that things are changing. 2020 has taught not just us but everybody that there is a need for collaboration, there is a need to improve, and not just the leaders but also the peers in the sectors are trying to develop synergy on ESG, and they're not likely to wait for another crisis for them to wake up and start doing things on ESG. So the pool for selection is going to grow in time, and it is going to come fast.
Thanks. Uh, can you point out the differences and similarities between QESG and the Quantum Long-Term Equity Value Fund? Is there any overlap of stocks and companies in both the funds?
Sure, we were anticipating this question, and so we do have a slide to showcase on that. If you see, the portfolios are very different. If you see within the ESG, which is 45 stocks, 32 of them are not there in the value fund. There are 13 common stocks between both the funds, but the overlap is just 28% for QESG and 49%. That these 13 stocks, the total of weight of these stocks is 28% in the ESG fund and 49% in the value fund. So if you see, there will be some commonality given that the emphasis on liquidity and governance, but it's very little commonality that you see, less than 30% common stocks. So the emphasis is very different. The construct is very different overall. We look at how the non-financial factors, like we look at financial sustainability, of course, but beyond that, we look at these non-financial factors like how the company ranks on various ESG criteria, whereas they look at the forecasted revenue, profitability of the company, and look at whether it's available at value at this point or not, and therefore they will make their portfolio call. Whereas, as Sneha explained, this is a value agnostic portfolio. If the company ranks really good on ESG, it will become part of the portfolio, and its ESG score will be reflective of the weight it gets in the portfolio. So there the valuations are driver of stock selection. Here, ESG is a driver for stock selection, and long-term sustainability is the driver, or sustainability of the company is driver for its long-term performance. That is how the fund conceptually are very, very different.
So Chirag, after adopting value style investing, why has Quantum decided to invest in ESG fund which follows the growth style?
So each style has its own merits and demerits. Like if you see a value as a concept, which usually not do during in frothy markets. Here, the idea was to bank on these good companies which are future ready in a way, and sustainability to be driver of long-term returns. And whenever you see many of these quality companies, they usually are expensive in a way, to an extent. Usually they will go through cycles, of course, but we wanted it to be true to label, and we wanted ESG to be reflective, or weights of the companies to be reflective of ESG and not other parameters. And therefore we didn't want it to choose a style. The style is ESG style. We want it to be growth. We don't want to be value. Uh, uh, the growth criterias or growth portfolio characteristics that you see in the portfolio today is just a byproduct of how we manage. It's not an intended bet that we are having. ESG is the bet that we are having when it comes to portfolio construction. So we wanted to be true to label and ESG be the driver, and that is how we have constructed. The growth style is just a byproduct of what style we have choose to pick stocks.
Can you share some more examples of success stories in sustainability, like Shree Cement that you shared?
Of course. Sneha, you want to take this one?
Yeah, sure.
The slide is on.
This is an initiative taken by Marico. So Marico, if you know parachute oil, that is what is the main product of Marico. So what they did was they started using 37% of materials from renewable sources, and the product in which they start selling the parachute oil, they are using 93% of the packaging material which can be recyclable. And if you look from the governance aspect, so although there is a higher promoter holding of about 60% in the company, it is still managed by a professional CEO. So it's making sure that there is independence in terms of the management, and not only the company is taking care of the environment, they are also making sure that the waste that is created by using or by selling of their product is managed in a recyclable way. And if you look at the performance of the company vis-a-vis its peers, the white line, which is the share price of Marico, it is clearly showing a significant outperformance as compared with peers. Also, the company has signed up to responsible sourcing norms in 2017. So even before started discussing ESG, the company was well ahead in sourcing in a responsible manner.
So just to add, there are many such stories or many such great examples of sustainability initiatives from many companies. If you were to look at our portfolio, the top weights that are there are reflective of how good the companies on ESG, and each one has a story around it. So all those are great examples of ESG excellence that these corporates have shown.
Chirag, what would you say is the case for an investor choosing an actively managed ESG fund over an ESG index?
So if you were to look at the ESG space, it's been evolving very rapidly. There are new things that we unearth on a very regular basis, and we continue to monitor those, learn from it, and imbibe into our process. So if you look at the way the indexes are constructed overall, you will see that many of them are very lopsided in terms of their allocation. There have been many changes that happen in terms of their sectoral allocations and stock allocations. So those are pretty frequent. And thirdly, when you're looking at ESG, and most indexes have a certain threshold of ESG score that they want, and beyond which any company has that score or qualifies, becomes part of the portfolio, but they are weighed based on the market cap of the company. So they are not truly reflective of the ESG criteria. Whereas if you see the way we have constructed, the higher the ESG score of the company, the higher the weight it's going to get, right? So the bigger the company, the bigger the weight it gets, not how good it is, right? So that's a flaw according to us, and therefore we said we'll not go that way. We'll construct it and let it be true to the label. And given that sustainability is the driver of long-term returns, it has to bank on ESG as the criteria for weighing the company in the portfolio, right? And if you are changing weights based on ESG, you are kind of in the active management space and not in the passive management space. And we think that active will kind of outperform passive in ESG, at least until ESG matures. So we think there is big scope, and till for a foreseeable future, uh, active will kind of keep outperforming passive. So there are various arguments in favor of active, and therefore I think investors should bet on active rather than going into the passive way of ESG investing. Because ESG is very subjective. It's like beauty lies in the eye of beholder. So it is very subjective in how you look at it. It is not tick the box kind of research. It is a 360-degree research, not a desk research, and therefore active will kind of outperform the passives.
Thanks, Chirag. So, Chirag, in a society like India, how do you reckon ESG investing will resonate with a common Indian investor?
So as I've said, profitability and responsibility are not two different things. They are complementary things, right? So if you are not investing responsibly, somewhere down the line, your investments have a high risk of failing, right? And so just don't go by the returns that you're getting. Look at the risk also inherent in those investments that you're making. And therefore Indian investors, if you see, are very conservative. They also kind of aware of the risk that have been in the equity markets, and therefore as they make the move towards moving into equities or increasing allocation to equities, I think if they adopt the responsible investing way, I think it will benefit them. So I think though it is new, I think people will embrace it going forward. They will see evidence that ESG really works, as we have shown in our track record, that ESG has performed better than most of the traditional indices. And therefore, I think when people see those kind of evidence mounting, they will continue to adopt it in a faster way.
Thanks, Chirag. My final question to you, Sneha. What differentiates the quantum ESG fund from the other ESG funds in the market?
So first, like there are a couple of points, but just first thing to highlight is that what Quantum does with the ESG fund is a pure active management way of investing. And not only we look at the scores or the ESG in the light of how the company is on ESG, but also we make sure that the ESG scores are reflected in the weights which are there for the companies in the portfolio. So we ensure that there is no skewness in the portfolio. We make sure that market cap or any other factor, be it P evaluation or any forward-looking parameters, are not uh, driving the portfolio management. And at the same time, we try to make sure that ESG is the hero of portfolio management and not anything else. So that is something which differentiates us from our peers. And the most important thing is most of the peers or most of the passive ESG indices are banking on third-party research. They take it from some other agency which is evaluating the company on ESG. So the biggest factor which is missing in this is interactions with the management, with the sustainability team, which give us more insight about the company, which is probably not there in the disclosures which the company is doing. So that is something which makes us stand in a different light as compared to what others are doing.
Yeah, just to add to what Sneha said, quantum ESG research is not something that we just decided a year before we launched and we kind of launched it. If you see, look at evolution, since 1996, governance has been an important pillar of how we scrutinize companies. Uh, we started ESG research in 2015, looking at ESG aspects, went through our own learning curve. And when we were confident of the process that we have evolved of looking at how we look at companies on ESG, we launched the fund in 2019. So it has been like 4 or 5 years before we launched the fund, and a lot of work has happened before that. It's not it's not that in ESG investing is a fad and therefore we launch it. We were one of the first guys to launch it, and it is as any of our product has. It is thoroughly research backed product and relies on proprietary research as opposed to any third party research. So that's the main differentiating factor.
Sure. So with that last question, we have come to the end of the Q&A. Thank you again, Chirag and Sneha. To our investors, we hope today's webinar has highlighted the emergence, the relevance, and the importance of sustainable investing going forward, and how Quantum ESG Fund can be a good choice for the same. Thank you all for tuning in. Good night.
Thank you.
The recording has stopped.